Hey everyone, in this video I'm going to answer which one I think is the better AI stock to buy, Soundhound AI, BigBear AI, or C3.ai. I'm going to compare these three artificial intelligence stocks across several critical financial metrics, including revenue growth, operating profitability, cash flow from valuation, and the overall stock valuation, the price to sales ratio, to determine which one I think is the better AI stock to buy today. So let's jump right into this interesting comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so before we jump into the revenue growth outlook, let's look at the total addressable market for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. All right, so now that you see the market potential, let's look at the revenue growth rate these three AI stocks are demonstrating. Soundhound AI with the most robust growth with 80.48% growth in the latest quarter. Next, C3.ai with 17.6% growth, and BigBear.ai, this isn't updated for its latest quarter. Its latest quarter was flat, but the latest data that YCharts has here is negative 16.39%. That improved to flat in its latest update, which was yesterday. So that's why this isn't yet incorporated into the data here on YCharts. Going forward, I think Soundhound AI has the best prospects in terms of revenue growth. The company increased its revenue by 80% despite decreasing sales and marketing spending by 30%. That's the strongest indication of organic revenue growth out of all these three AI companies here. So the next thing I wanted to compare these three on is operating profit margin, and they're all losing money on the bottom line. And I've said this before, when I'm looking at companies that are losing money on the bottom line, what I want to see is progress. I want to see improvement. And the most pronounced improvement I see is from Soundhound AI, improving from negative 450% to negative 139%. Those restructuring moves the company implemented, including what I mentioned earlier, the 30% decrease in sales and marketing, are helping improve profitability along with the revenue growth. C3.ai is moving in the wrong direction, negative 104%, but you could see it's just going downward. It's not moving upward. And BigBear.ai is relatively flat, down a little bit, but still negative at negative 21.44%. So I want you to understand the cash flow from operations metric. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you've got a better picture of this metric, you can see Soundhound AI, again in last place here, but making the most progress, negative 148%, negative 19% for C3.ai, and negative 18.56% for BigBear.ai. Soundhound AI, again, the only one making a pronounced improvement, a pronounced step forward in this metric. And finally, I want you to understand the forward price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. So now that you've got a picture of this metric, you can see Soundhound AI is the most expensive according to this metric at a forward price to sales of 17 compared to 10 with C3.ai and 2.1 for BigBear.ai. That being said, if I was to pick one of these three AI stocks to buy today, I would pick Soundhound AI would be my top stock pick, followed by BigBear.ai, and C3.ai would be last place according to my personal rankings. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.